Homeowners around the country are quietly getting their mortgage payment lowered, hundreds of dollars a month, without refinancing and without giving up the low rate they locked in years ago. The move is called a mortgage recast. You see, you send your servicer a lump sum payment toward principal. At some companies, all it takes is $5,000, that's the minimum. And other companies will actually allow you to retroactively add up past additional principal payments you've made. And then what they do is they rerun the math on what's left, and your monthly payment drops permanently. Same rate, same payoff date. No new loan, no closing costs, no credit check, no appraisal. Rocket Mortgage publishes the fee right on their website, about $250, which raises two questions. One, if it's that simple, why have you never heard of it? Well, the answer is about who gets paid when you don't use it. I mean, if you don't ask, they won't tell. And two, the people who have heard of it are having a knockdown argument all over the internet about whether it's even the right move to make. So I'm going to settle both before we're done, and the second answer might be worth $48,000 to you on average. Now, if you've ever wanted a lower payment, you already know the product that they sell for that. Refinancing. It's the one with the commercials. So let's kill that one first, because this week it officially died for a long time, for a while. Freddie Mac says the average 30-year mortgage rate just hit 6.55%, the highest in nearly a year. Third straight week, I think it's the fourth straight week of increases. So here's what that means in dollars. A $400,000 loan at 3% runs $1,686 a month. Replace it at 6.55%, and replacing your loan is exactly what a refinance is, and the same debt costs $2,541, $855 a month more. Over 10 grand a year. I mean, who would do that? Refinancing toward a lower payment, that's pretty much off the table for most people right now. It only goes one direction from here, and that's up, which is exactly why the recast matters. It's the one move that lowers the payment without touching your rate. And if you're not sitting on some killer 3% loan, if you bought recently, say at 6 or 6.5, or if you bought 5 years ago at 3%, this move, it still works from wherever you're starting. Now, the fine print most won't mention until the moment you say, sign me up, is a standard recast only works on conventional loans. FHA, VA, USDA, the answer is generally no. Now, if that's your loan, don't click away. There's a version of this that will still work for you, and I'll get to it. But here's exactly how a recast works, start to finish. You call the company you send your payment to, the servicer printed on your statement. You ask if your loan qualifies. If it does, you make a lump sum principal payment. Common minimums run from 5 to 10 grand, that's the starting. And most lenders will even count extra principal payments spread across 12 months. The servicer then re-amortizes your loan. So your new, smaller loan gets spread across the years you already have left at the rate you already have. So the payment, it drops, and it stays dropped. And let's kill the biggest piece of confusion right now, because it's everywhere. A recast does not restart your clock. Your payoff date does not move. It stays the same. You see, a refinance, this is the thing that hands you a brand new 30-year clock. A recast keeps your date, keeps your rate, and simply respreads the smaller balance. And there's no credit check, no appraisal, no application in the mortgage sense. Processing typically runs 30 to 45 days. That's it. And the fee? Industry guides put the typical range between $150 to $500. Some servicers waive it entirely. And homeowners out there report everything from free to $750 depending on who holds the loan and who you actually call and talk to at your company. Now, where does a lump sum come from, Matt? Fair question. Odds are it's from one of these places. It's going to come from the proceeds check when you sell another property. It can come from an inheritance a lot of times, a CD or a settlement that just matured. Maybe you got a bonus from work, or years of extra principal payments you've already made, because some servicers count those toward the minimum, and some only count the trailing 12 months. But you've got a lot of options. And that points at something bigger, because everything I've said so far assumes you're staying put. So here's the version for the family that has to move. The job transfer, the health situation, the divorce. You see, your problem is kind of brutal these days. You can't time the sale of the old house against the purchase of the new one. And the new loan is coming at today's rates. So run this sequence. Buy the new place with the smallest down payment that gets you approved, so you stay liquid through the transition. Yes, I know the payment on that new one, it's gonna be really ugly, but it's temporary. The old house, when that sells, the proceed check clears, and instead of just letting that cash sit, you send it into the new loan and recast it. So now the payment drops to where it would have been with the big down payment originally. But you never had a single cash poor month in between. Some lenders will even suggest this one themselves during the application, because on a brand new loan, there's finally something in it for them. A recast isn't only for defending the house you're in, it's the landing gear for the move you can't avoid. So let's put some real numbers on screen and compare a recast to a refinance. Let's say you refinanced 400 grand at 3% back in 2021. 5 years of payments later, you owe about $355,000, and your payment is $1,686. Now, an unexpected or expected 50 grand lump sum finds its way to your bank account. One option, you got the recast. Your balance drops to about $305,000. The servicer reruns the math across your remaining 25 years, and your payment now falls to $1,449. That's $237 a month back in your pocket permanently for a fee of a couple $100. And compared to doing nothing, you pay about $21,000 less interest over the life of the loan. Now, option two, the refi. Now, this is probably not going to make sense for you right now because we know what the interest rates are, but let's just make it a fair fight anyway. Let's compare them side by side the best we can. Same house, same 50 grand out of your pocket, you put it down at closing. So you're refinancing the exact same $305,000, but here's where the paths split, because the bank doesn't sell a 25-year do-over. They sell you a brand new 30-year loan. At 6.55%, that payment comes out to $1,942 a month. I mean, who would do that, right? But look closer. Here's a part of the refi that nobody really gets. The first thing, the years. The recast has you done in 25. The refi has you paying for 30. Because a refi restarts your clock, and restarting the clock does something really ugly to every check you write. You see, you spent 5 years working your way up your loan to where your payment was actually starting to buy the house, where your payment was actually being attributed to some principal. The refi sends you back to the starting line. So watch where next month's payment goes. On the recast, $685 of it buys your house, meaning it goes to principal. On the refi, only $274 goes to principal, and $1,686 goes to interest. Same balance on both paths. On one of them, your money stopped going to the principal. You went all the way back to the beginning, and now you're just paying interest. But add up every payment left on each path, same house, same 50 grand in, the refinance costs you $264,000 more, plus $6,000 to $18,000 in closing costs up front for the privilege. 5 more years, $250,000 out to go backwards. There are timeshare pitches with better math than that. And at least the timeshare throws in a free breakfast. One option costs a couple $100 and drops your payment. The other costs thousands up front, raises it, and prolongs it. Really, the only time to do a refi is when you can pull that money out and put it to work better somewhere else than it was working inside your home. That's really it. So this isn't really even a fair comparison, but it's what most people understand, so I wanted to put them side by side for you. And that brings us to this question: why doesn't your bank lead with the cheap one? Why don't they show you the recast? Why do they advertise the refi? Well, follow the paychecks. You see, a refi generates origination fees, closing costs, and a brand new loan to package and sell. That 2 to 6% doesn't evaporate. It lands in somebody's asset column. A recast generates a flat fee once, and the servicer gets to keep babysitting your old loan. And listen to the language they use for the expensive one. They never say take on a bigger loan. They say tap your equity, like your house is a keg at their party. Now, I want to be careful right here because there's a line between receipts and conspiracy talk. I can't prove anyone is hiding recasting from you. I mean, Chase has a recast page on their website. Rocket publishes the fee. So it's not a secret. It's just orphaned. Nobody in that building gets paid when you use it. So nobody in that building brings it up. That's not a cover-up. That's a commission structure. Now, the second question, the argument. The sharpest pushback on this whole strategy goes like this: why recast at all? Just send the same lump sum. Do not recast. Keep making your old payment. You'll save far more interest and finish years earlier. And here's what nobody defending recasting wants to say out loud. That math is right. Watch. Same homeowner, same 50 grand. Play number 1, the recast. Payment drops $237, and you save about $21,000 in interest. The payoff date, unchanged. Play number 2, keep the payment. Send the 50 grand, change nothing else, keep paying $1,686, and that loan dies about 5 years early, saving you roughly $48,000, more than double the savings. That's the whole internet argument. Two crowds yelling about which prize is better. So is the recast a bad move? No. It's the answer to a different question. The same $50,000 buys one of two prizes, and you only get to pick one. Prize number 1, you got some breathing room now. $237 a month worth, starting immediately, which matters enormously if you're on a fixed income, if insurance and property taxes keep climbing, if a medical bill just landed. Prize 2, you get to the finish line sooner. 5 years and 48 grand you save, which matters if your income is strong and you just want out of this loan as soon as possible. Now, neither one is a mistake. They're just different solutions for different problems. The mistake is writing the check before you know both plays exist. And if your loan is FHA, VA, or USDA, play number 2, the lump sum with no recast. That requires zero eligibility, no servicer approval, no fee, no loan type restriction. Extra principal works on every mortgage ever written. Your lender can tell you no on a recast. Nobody can tell you no on paying down your own loan. It's the one financial move in America that needs no approval, no middleman, and no fee, which is probably why you've never seen a Super Bowl ad for it. Now, there is actually a third option if your goal is to simply maximize your ROI, your return on investment. You see, if you have one of those 3% loans, it might make sense just to leave it there as is, considering inflation is running at 4%. In that scenario, in real terms, your mortgage is a negative 1% rate. Effectively, you're being paid to keep that mortgage in place. You're being paid to borrow that money. So it could be logically argued that your 50 grand could be better utilized, say, in the market, or buy some gold, or some Bitcoin, or by picking up an income property, or hunting for a Shohei Ohtani rookie card. That's a risk and sleep at night decision for you, not a math error in either direction. And it's a different video too. The point being, it's first a defining the problem issue. What's going to solve your problem? Second, it's then a math equation and a risk analysis. The bottom line, if you've got a home and you fall into some extra cash, you've got a lot of options. So here's your mission this week. 3 moves in order. Move number 1, tonight, pull your latest mortgage statement. There's 2 numbers there, your interest rate and your remaining balance. If that rate starts with a 3 or lower, you are holding the exact asset this entire video is about. Protect it. Be deeply suspicious of anything that replaces it. Move 2, 1 phone call, 3 questions in this order. Question 1, is my specific loan eligible for a recast? Eligibility first. If the answer is no, you've got your answer in 90 seconds and you just move straight to play 2. Question 2. What is your exact minimum principal payment? And what is the fee? Get both of those in writing if you can. Then question 3, the one almost nobody asks, do the extra principal payments I've already made count toward the minimum? And how far back do you count? Some servicers count everything. Some only count the last 12 months. That one answer can change your whole plan. And while they're on the line, one bonus question. How many times can I recast this loan? Because some servicers allow repeat recasts, and that turns this from a one-time move into a real strategy. Then move 3, before a single dollar moves, run both plays on paper. If I recast, what's my new payment, and is that acceptable? If I make a bulk payment, what's my new payoff date, and can I deal with that? Pick the prize that matches your actual life, matches your priorities, solves your problems, makes your life better. Because here's where this lands. You can leave your payment on autopilot and let the market decide what your options are, or you can make 1 call, ask 3 questions, run both plays, and decide on your own terms. You see, nobody's coming to walk you through this. That's why I just did. And here's the question that's probably going to bother you a little bit tonight. You see, that was 1 move, inside 1 document, in 1 corner of owning a home. If that was hiding in your blind spot the whole time, what else is? You see, 20 years in this business, and I'll tell you, the recast isn't the exception, it's the pattern. The most expensive parts of owning a home aren't the bills you pay, they're the things nobody ever showed you. And that's exactly why I pulled this video right here out for you to watch next. Because after years of covering these stories one at a time, I finally sat down and mapped out where the gaps actually live and how to see the whole board at once instead of finding out one expensive surprise at a time. So it picks up right where this one leaves off. You know, you just found one blind spot. Go find the rest of them. Run your house like a business. Defend it like your home. God loves you, and so do I. Take care.